In the wild world of finance, you've probably come across the term zero-sum game, especially in discussions about investments like Bitcoin and other cryptocurrencies. But what does it really mean? It's like a simple card game where one player's win directly results in another's loss. The total amount of money doesn't increase, it just gets redistributed from one player to another. That's the essence of it. In a true zero-sum game, every gain is balanced by an equal loss, so the overall sum remains unchanged. To start with, Bitcoin and other cryptocurrencies thrive in a highly volatile market, meaning their prices can fluctuate dramatically in a short time. This kind of instability hits everyday investors hard, particularly the small ones who lack deep pockets or the advanced strategies. Take, for example, the infamous crypto crash in May 2021, when Bitcoin's price dropped more than 20% in just 1 hour, pulling the entire market down with it. This was sparked by a mix of factors, including regulatory crackdowns in China and sudden sell-offs by major holders, which created a domino effect. Small investors, who often pour their life savings into these assets hoping for quick profits, were devastated. They watched their portfolios vanish overnight and struggled to recover, often forcing them out of the market entirely. And let's not forget the ones who used leverage trading, amplifying their risks even further and making their losses that much worse. Now, diving deeper into the zero-sum aspect, in a classic zero-sum game, every win necessitates an equal loss, essentially transferring wealth between participants without generating any new value. Cryptocurrencies exhibit elements of this, particularly in trading situations. For instance, if someone buys Bitcoin at a low price and sells it at a high one, they're effectively profiting at the expense of the buyer who paid too much. The winners are those clever traders who perfectly time the market, walking away with profits, while the losers, perhaps those who jumped in at the peak, end up bearing the brunt of the losses. It's a straightforward wealth transfer among players, no question about it. On the other hand, Bitcoin and crypto aren't entirely zero-sum games because their value often rises due to an influx of new capital, rather than any real productivity like a company's earnings or a factory's output. Just think about it, Bitcoin doesn't create tangible goods or services, its worth is driven mainly by digital scarcity and the power of network effects. When fresh investors flood the market with money, that surge pushes prices higher, making it feel like a positive-sum game for all involved, at least while the bubble is growing. Even though it's not a pure zero-sum scenario, it's worth noting that in this volatile market, the majority of participants end up suffering losses, which points to a constant wealth transfer toward the wealthier players happening every single day.